Good morning. Maybe I should good afternoon. I'm not 100% sure, but I'm glad to be here, at least virtually. My name is James Carr. I'm director of West Coast Dairy. I'm going to be giving the dairy outlook for the group today. First thing we have to do is we have to satisfy some compliance issues. I'm told that I have to have this on the screen for 30 seconds. So normally I would tell a joke, break the ice, make you chuckle, do something like that while we waited. Today, we'll just sit here and stare at a clock for another 10 seconds, and then we'll move on. Okay. You can't talk about 2020 unless you talk about volatility. We have seen in the dairy space block cheese drop to $1 and block cheese rise very quickly to $3, which is an all-time high. As you know, we had a little issue this year called COVID, and back in March, we essentially completely shut down any type of food service demand throughout the United States, which took block cheese down significantly, like I said, to the low of $1. And then as we saw the food box program get announced, we saw the market start to open up again, or at least the restaurants start to open up again. We saw some stimulus checks directly to the farmers, stimulus checks directly to consumers, and the market recovered significantly and quickly back up to, or I shouldn't say recovered, it recovered and flew by normal pricing up into all-time highs. Why did it do that? Well, as you can see, volatility was initially driven by a collapse in food service sales. We saw food service in March and April drop over 50%. We did see some retail sale growth up 30%, but the 30% increase in retail sales is nowhere near the 50% decrease in food service sales, or demand, I should say. Then we moved forward. We saw as we opened up again, as we got guidelines for how to try to mitigate COVID. We saw the markets open up, or at least the restaurants open up a little bit more. Food service demand has come back. Retail is still up. It's still growing. That's probably something that's going to stay in the mix. A lot of people realized, I think a lot of people realized how much cheaper it was to eat at home, got used to eating at home, and they'll probably continue it to some extent to continue that habit. So our expectation is food service demand will continue to struggle a little bit. Retail sales will continue to be a little bit better. And of course, everything is predicated on whether we completely shut down this winter again, or if we get a big stimulus bill, which we'll talk about a little bit later. To give you an idea of how impactful government payments were to the dairy industry, these two charts or histograms show it perfectly. This is government stepped in and bought about 240 million pounds of cheese in 2020. And as you can see in June, July, August, we were nearly, or well, you might as well call it 3.5 to 4% of the U.S. production was being purchased by the government. This is fine on a short-term basis, but as you can see, as we trail off, those purchases have to be replaced by something else. What are we going to replace it with? Our question is, are we going to see retail sales continue to increase? We're going to see food service get better because someone's got to replace it. Or if it doesn't get replaced, we're going to see these prices move significantly lower. To give you an idea of the situation with sales or demand, if we net out all government payments, so you look at U.S. domestic cheese disappearance, excluding government purchases, it's pretty much flat to lower. You can see that in April, disappearance was down 10%. In August, disappearance was down almost 6% year over year. Same thing in butter, same thing in fluid milk sales, same thing in the total U.S. milk equivalent disappearance of all of those. Fluid milk, a lot of it's drank and utilized in the school system. So with the schools being shut down and homeschooling, you're going to see less fluid milk sales. So how does that affect us as we move into 2021? Without government purchases, we don't think the U.S. can support the current milk production and prices, and we expect that margins will move lower. As you can see, this is a chart we look at all the time. It's an expansion-contraction chart, essentially saying if margins drop below $9 a hundredweight, we will see a contraction in the national dairy herd. If margins are above $11.50 a hundredweight, we see an expansion in the dairy herd. As you can see in 2020, we've seen both. So late 2019, we had very good margins, low feed costs, pretty good prices. And then we moved into the first quarter of 2020, the prices started moving lower. As expected, it's after Christmas. Demand is at the weakest in Jan, Feb, March. So that wasn't unexpected. We weren't expecting this to be anything out of the ordinary. Probably moved back towards that $11 range, $10, $50, $11 range, and it wouldn't have been an issue. We would continue to move along with a normal production curve, and things would have been fine. But then, of course, COVID came, and we saw that margin drop to near nothing. I mean, $7.50, let's call it. You're not paying your feed bill for that. So we did see a very quick contraction in the dairy herd that would have continued if the government purchases hadn't come. But since we did see government purchases, block cheese moved up to $3, barrel cheese came up, class 3 came up. We had no incentive to decrease the herd anymore, so that just went away. Now we did have probably some class 4 people that were getting hammered and still are getting hammered, that we saw some reduction or contraction in their herd, but from a national level, we didn't see any contraction. In fact, we saw growth moving in, and we will continue to see growth as we push through the end of the year. Now, we do believe that we'll see a significant drop in margins moving into the first quarter, which should slow down or at least pause that growth. But, this is being recorded on December 8th. A lot of things can happen between now and the first of the year. We could get a stimulus package. We could continue to see even more regions shut down food service as COVID cases spike. We don't know at this point, but our expectation is we're going to see more shutdowns, which is going to push price lower, which is going to reduce margin, which will eventually reduce production, and probably help prices going into the third and fourth quarter. This is our production, just kind of our production curve. As you can see, seasonality. Seasonally, we should see production start to drop in January, February, and March, which is normal, and then recover back as we get into the second half of the year. But our forecast right now is for that production to tighten up a little bit. So that should help prices as we move forward. Feed costs are a risk that we are monitoring here very closely. South America is struggling right now. struggling is the wrong word. There's some uncertainty to the supply that's going to be available in South America. And the market is rationing demand right now to try to figure out where that supply is going to come in at. Now, I think that this adds some significant risk to feed costs for in the dairy industry, but I also think that it's something that's going to solve itself, or at least give us some clarity sometime early in the first quarter. We'll have a pretty good idea of where South American crops are going to be for harvest. Trade will start looking towards that harvest, and I think prices should mitigate as we get closer there. Now, before that, we could see corn and beans move significantly higher. Soybean meal is going to stay expensive. Proteins are probably going to stay expensive until we get towards that, probably closer to U.S. harvest for some of those proteins. But it'll all depend on how South America comes through in Jan-Feb. Idaho specific margins. Idaho feed costs are moving higher. As you can see, we're forecasting, or we're showing that feed costs into middle of January or middle of 2021 are going to move up towards that $11 hundredweight range. That reduces margin, as you can see in the second chart. That reduces margin into the first part of 2021 down to into that $6 to $7 range in Idaho, which should contract the herd. It'll all depend on where people sit on their base programs. If someone is above base, they'll continue to drop. If they're at base, I'd be very surprised if they would continue to reduce their herd. But as you can see, we've got milk for the all milk price. In 2020, it's going to be average about $18.29. Feed costs at $9 for a margin of $9.20, just over $9. And then in 2021, you're going to see price drop $1 and feed costs increase $1 and some change. And margin, our expected margin is going to be, like I said, under $7, which should contract the herd on a normal year. This is this is a chart we like to look at a lot. And we look at it in all the products. I just happen to be using class 3 here today. It gives us the percentiles. So the pricing that we were just in, we were in the upper 10% of percentiles or prices for the last 5 years. Now we've moved back down into that more average range. And our expectation, futures have us continue to be in that average to lower range. And depending on stimulus, we're probably going to be below that average line in the first quarter, starting to push higher in the second and third quarter, depending on, again, stimulus and production. This is a class 3 market in 2020, 2021, and 2022, just the futures curve. As you can see, 2021 and 2022, they've got it really just floating right around $16. I don't know if this chart says anything except that the market is not sure where we're going to be in 2021 or 2022. And they're not willing to step out and take any major directional positions. Class 4, which has just been an absolute dog. It is probably one of the, let me say this correctly. It is very unfortunate that our political leaders didn't understand the impact that the food box program was going to have on dairy, but also leave so many people behind in the dust. So the food box program focused on cheese. Great. Cheese is great. Everyone loves to see cheese. Everyone loves to give away cheese. It looks good. It makes a good picture. It's more fun to give a guy a block of cheese than it is to give a guy a bag of non-fat. But unfortunately, that means we had essentially an economy of haves and have-nots. You had the cheese-connected dairymen or processors that were faring very well, getting in the upper 10%, upper 1% prices. And then you had the butter powder producers and processors that continue to have milk pushed back on them because the cheese processors don't want to build any inventories at high prices. Food service is utilized significantly more in the class 4 market. I mean, percentage-wise, you've got butter and cream that is used significantly in food service. And, you know, what's the default? If you've got milk being pushed back on you as a co-op, your default is to make powder because that's what you've spent your equity on and your assets on in the past. So you make powder, which stockpiles powder. Exports then have to try to make up for that extra production, and it just hasn't been doing it. Luckily, since April, we have seen the prices get a little bit better. But I mean, look at that. You compared to $23 class 3, and we're peaking after COVID at just over $15, and the forward curve for 2021 is well below break even. So this is something that we need to try to fix. I don't know how to do that. I hope the government in the next stimulus package, like I mentioned earlier, will solve some of those issues, give some support to the producer that has been suffering these $10, $11, $12 class 4 market. Class 4, the forward curve, looking a lot better. Not great, but still looking better than 2020. As you can see, 2020 spent most of the time under $14 and a lot of that time under $12. But 2021, we see a forward curve, obviously January, February, March, still under $14 or right near it, and then a recovery back into the latter half of the year into at least, I'd expect break-even pricing. Still not great. Still need some help there. I'm not sure where that's going to go. The last thing I'm going to cover is dairy revenue protection. We saw in 2020 a lot of coverage utilized in dairy revenue protection. Paid out a lot of money in Q2, paid out some money in Q3, mostly from a class 4 standpoint, just because we did have such good prices in the third quarter. But this is something that every dairyman needs to be looking at. The nice thing about dairy revenue protection is it's subsidized by the U.S. government at the 95 percentile range. It's subsidized at 46%. No, scratch that. 44%. You pay 46%. Excuse me. But the idea is you're locking in a floor using the insurance product. You're paying a reduced premium, and you have all the upside. So you can go out there and you can lock in an insurance price, either using class or components, depending on what fits best for your farm, and at least have some semblance of protection for the unknowns. I mean, who knew COVID was coming before January of this year? It's those types of things that we manage risk for. It's not the seasonalities. It's not elections. It's not dollar currency fluctuations as much as the unknown, catastrophic things that can cause demand to just completely collapse. So if you haven't discussed dairy revenue protection with anyone, please do. Feel free to call me if you'd like, but at least go talk to somebody about it, because it's a tool that can save you when you really need saving, and also it's cash efficient because of those subsidies. So with that, I'm going to say thank you for your time. If you have any questions, please feel free to give me a call.